Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Tuesday everybody. Yesterday we discussed China's outbreak and lockdowns in depth. Over the last 24 hours, however, conditions have worsened even more, so it's worth having a quick update on the situation and then unpacking further the nature of Beijing's zero-COVID dilemma. A new lockdown started yesterday, Monday, in Fenyang City in northern China's Shanxi province after a preliminary positive case was found in citywide testing the previous day. Restrictions in the Inner Mongolia region's capital, Hohhot, have intensified, with outside vehicles and passengers prohibited from entering the city from today, Tuesday. Snap lockdowns have been rolled out in Shanghai over the last 48 hours too. 2 districts in the megacity have shut entertainment venues. In another district, Minhang, several sizable areas are now designated as medium risk, which in practice means that residents are restricted from leaving their compounds. Shanghai officials announced yesterday that anyone traveling to Shanghai will need a negative COVID result within 24 hours of arriving in the city and will have to do 3 tests over 3 days. Yesterday, we discussed that the new subvariant BF7, which is thought to be more transmissible, has been discovered in China. Today, it was confirmed too that a highly contagious Omicron subvariant, BA517, has also been identified in South China's Guangdong province. As we all know too well, the economic cost of zero COVID is massive. According to data compiled by Zheng Yu Huang of Tsinghua University, in the first half of 2022, 460,000 Chinese companies and 3.1 million private businesses went out of business, either directly or indirectly, due to zero COVID. As for the testing costs, last week, the state-run Bank of China put PCR testing alone at almost $100 billion a year. Perhaps in response to growing public dissatisfaction with the COVID situation and increasingly tight measures, state media published a set of pieces yesterday supporting the policy. For example, the People's Daily writes, quote, "The epidemic has not gone away, and our big exam is still ongoing. Practice has profoundly enlightened us that there is no way out for lying flat, and persistence is victory." End quote. In a state-run Xinhua article, we can see the authors responding to popular arguments domestically against zero COVID, as well as questions regarding why so much of the rest of the world has opened up, but not China. Quote, "Recently, some people have seen that some foreign countries have chosen to lie flat in the face of the pandemic and believe that our country's insistence on dynamic zero COVID is too costly and should follow suit to achieve coexistence with the virus. This is an extremely wrong and irresponsible view. The Omicron variant is by no means just like a bad flu, and it spreads fast. For vulnerable groups, especially the elderly with underlying diseases, severe and fatal rates are still high. Therefore, we must stick to our own path and persistently do a good job in epidemic prevention and control." End quote. But normalization will eventually need to happen. The question is when, and as we all know in this regard, Beijing faces a tough dilemma. Quote, "Beijing's intransigence has come at an escalating cost. Prolonged lockdowns of millions of people in major cities, such as Shanghai, have not only devastated China's economy, which is now expected to significantly fall short of growth targets, but also provoked rising social discontent. So the government faces a growing dilemma. On the one hand, its zero-COVID strategy is sufficiently unpopular that few government officials are prepared to publicly endorse its long-term existence, and international pressure to abandon the policy is mounting. On the other hand, political considerations and the lack of a clear alternative have prevented Beijing from moving away from it. If China's leaders fail to change their approach, however, it may not only leave the country exposed to an unending cycle of outbreaks and lockdowns, it could also threaten its long-term social, economic, and even political stability." End quote. Huang also identifies 3 factors that make Beijing reluctant to abandon zero COVID. The first is that a late pandemic surge in cases would be devastating to a population with no immunity. Huang points out that vaccines are unpopular because there is a lack of confidence in the safety and effectiveness of Chinese vaccines, and also that there is not an insignificant number of retired officials in Beijing who still enjoy influence over top leadership and policymakers who are vaccine skeptics. Second, Huang argues, despite rising discontent, Beijing understands that a significant portion of the public, especially in smaller towns and rural areas, still strongly support the zero COVID policies, which he attributes to, quote, relentless state propaganda and their lack of access to independent information, end quote. And third, and perhaps most critically, important political interests are benefiting from zero COVID. Quote, hundreds of Chinese companies, for example, have reaped enormous profits from providing rapid PCR testing services, which China has implemented on a massive scale. According to one report, in the first half of 2022, China's top 10 testing companies raked in a combined 48.52 billion yuan, approximately $6.8 billion in revenue, and China's political leaders themselves, having put so much political and economic capital into the strategy, have an incentive to stick with it. End quote. Next up, the Chinese economy. Hello everybody, if you're enjoying this episode of China Update, don't forget to hit the like button, it's a big help. And for anyone who wants to go the extra mile and help me keep China Update sustainable, help me continue making these episodes for you guys every day, Patreon and Buy Me a Coffee links are in the description below. As always, thank you so much everybody for the ongoing support. Now, let's move to the Chinese economy, and we have 2 major developments to cover. We recently covered new US restrictions on selling advanced technology to Chinese firms, aimed at stopping China from developing homegrown semiconductor capabilities. As industry commentators and analysts explore the implications of these new measures, it's becoming clear that the restrictions will be quite painful for Chinese semiconductor ambitions, in the short to medium term at least. With the new export restrictions, the US is forcefully decoupling the entire advanced technology supply chain before China is able to insource it. AI and HPC chips are restricted. Equipment for 16 nanometer or more minor logic chips are restricted too. Many major Chinese companies and universities no longer have access to the American supply chain, which includes practically every large company in Europe, Japan, Taiwan, South Korea, Singapore, and India. Analysts agree that China's chip giant, Semiconductor Manufacturing International Corp, SMIC, will see substantial damage from the new restrictions. For example, Bloomberg Intelligence estimates that SMIC could see 2023 sales growth 50% lower than previously expected due to these new restrictions. Roughly 48% of the company's capacity to be installed by next year will require gear from US toolmakers. In trading in Hong Kong yesterday, the company's stock fell as much as 5.2%. Over the weekend, Chinese state media attacked the US restrictions and bemoaned, quote, the US hegemony in science and technology, end quote, with the state-run Global Times writing, quote, only arrogant and ignorant people can truly believe that the US can block the development of Chinese semiconductor and other technology industries by these illegitimate means, end quote. Meanwhile, the US Defense Department has also recently added more Chinese companies, including drone maker DJI Technology and surveillance equipment maker Zhejiang Dahua Technology, to a blacklist that subjects them to an international ban for Americans. Next up, a brief but important housing sector update and how the ongoing crisis is bleeding now into the trust industry. Bloomberg's Hong Kong team writes today that the main units of China SCE Group Holdings Limited and Shimao Group Holdings Limited missed payments on 1.6 billion RMB, $225 million of trust borrowings, quote, continuing a string of defaults by Chinese developers amid the industry's liquidity crunch, end quote. The former was especially shocking to the market as, until now, the company had shown little sign of distress. The financial outlet explains that Xiamen Zhongjun Industrial Co., a unit of SCE, and one of the guarantors failed to repay its 50% share of the trust product that was due at the end of September. Xiamen Zhongjun and Shanghai Shimao Jianshe Co., the other guarantor, both had their bank accounts frozen by a court after Evergrande Trust sued to seize assets. The housing market slowdown has contributed to a surge in missed payments in the trust industry, which has about $3 trillion worth of outstanding high-yield products sold to wealthy individuals. That includes about $200 billion worth backed by developers. Defaults on property-linked funds amounted to 56 billion RMB in the first half of this year, accounting for more than 82% of the total, according to the research provider Ustrust. These moves in the trust sector are ongoing developments, which we will continue to follow closely. Okay, that is today's episode of China Update. Thank you so much, everybody, for watching. I'll see you all tomorrow.